Vishal has set out the journey to good investing. The road to successful investing requires quantitative analysis of three main financial statements: the profit and loss statement, the balance sheet, and the cash flow statement. To fundamentally analyze a company for a successful investment, you need to calculate 5 major ratios to detect the financial health of a company. The first ratio is ROE, the return on equity ratio. ROE measures the returns generated by a company by deploying the capital of their shareholders. And ROE helps understand the management capability of a company and can also be used to compare its profitability with other companies in the same industry. As a rule of thumb, an ROE of 15% and above is considered good. If the ROE is much higher, it could be a sign of the company using the shareholders' equity very effectively, which drives the ROE. However, a really high ROE could also raise a red flag if a company has high debt financing, which in turn might inflate the ROE temporarily. The second ratio to check is interest coverage ratio. This ratio determines if the company can afford its interest payments solely from its operations income. It also gives a clear picture of the company's solvency. The third ratio is the current ratio. This helps an investor determine the liquidity of a company, that is, how well it can meet its short-term debts and obligations through its short-term assets. Usually this ratio should be greater than 1, which would indicate that the company is able to meet its day-to-day obligations without affecting its working capital cycle. Next stop is calculating the debt to equity ratio. This ratio helps determine if the company is using more leverage or more of shareholders' equity to run its business. A ratio less than 1 is preferred as it hints at lower debt usage compared to equity. However, this isn't a rule of thumb as it varies from company to company depending on the nature of the industry. A high debt-equity ratio may lead to a higher risk of credit default. The last important ratio is that of operating margins. This ratio denotes the profitability the company is able to generate from its core operations. The higher the operating margins, the better it is for the investors. So, this completes Vishal's understanding of the 5 main fundamental ratios, getting him right on track to a life of good investing.
To know more in depth about the various financial ratios and how they work, tune into our Financial Ratios movie.